Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on how to manage your money better. And one of the big talking points from last week is the outcome of the Reserve Bank of India's monetary policy review. And, of course, that was to cut the policy rate by 25 basis points or 0.25 percentage points. Effectively, that means for you that your loans get cheaper and so do your fixed deposits. But there are implications for the bond markets and also, from that perspective, for your debt mutual funds too. I'm going to talk about the latter at the start. Then we're also going to have a conversation about how you should plan your loans. And finally, we'll talk about what the implications are for hybrid mutual funds. But for the first leg of the conversation, let me introduce you to the first guest. We've got Mahendra Jajoo, who's the CIO of Fixed Income at Mirae Asset Investment Managers. Mahendra, thanks so much for taking the time. First, do you think that we have reached the end of the current cycle of interest rate cuts and that not too much more is anticipated from this point?
Well, to me, it seems that there is a possibility of at least one more rate cut going forward, because if you look at the macro picture, our inflation is currently at about 0.25%, and as per the Reserve Bank's projection, for the full year, the inflation should be somewhere closer to 2%. And then in the first half of the next year, the inflation is not expected to inch even up to 4%, and that leaves a significant room for additional rate cuts by the Reserve Bank. And on top of that, our nominal GDP rate is very low, as has been, a lot of debate in the markets about the real rate being good, but the nominal GDP growth rate being not so good because of the low inflation. So there is a need for the Reserve Bank to push up the nominal GDP rate so that the corporate earnings or the tax collections are in line with the budgeted estimate. And therefore, I think that there is room for additional rate cut going forward.
So, and I would assume that another 25 basis points or 0.25 percentage points, which would bring the repo rate to 5%. And Mr. Jajoo, this is also a show that caters to a wide audience. So for the benefit of those that don't understand what this means, effectively you're talking about the repo rate, which is the rate at which the RBI lends to banks and then the banks lend to other people. So effectively, if that rate comes down, eventually the rate that goes to you also comes down. But Mr. Jajoo, then what are the implications for a fund manager like yourself and for your own expectations for how your portfolios will work in the debt market? Do you think that there is the ability to earn more from duration, that is the longer paper?
Reserve Bank not only did it cut the repo rate, they also announced the open market purchases of bonds of about 1 lakh crore, and I believe they will do more. And they also announced a buy-sell swap for the rupee dollar for 5 billion. So, just to explain again to the audience, these measures support lower interest rates and then they inject more liquidity in the system. So therefore, I think at this point, there is a certain amount of optimism for the bonds. I think the duration to some extent is again going to be in play. However, there needs to be a note of caution that globally, the trend is for the long-term interest rates to go up. In most of the developed economies, the inflation is well above the target of the central banks, specifically in US. And therefore, even though those economies are cutting interest rates, but because of different factors, including the lower reducing demand for those bonds, the long-term rates have been going up, and that's what we have seen in India also. That even as the Reserve Bank has cut the repo rate by a cumulative 125 basis points in the last 1 year, since the last cut in June, the long-term rates have gone up, and India is also facing a bit of a challenge in terms of closing a trade deal with US. And that can put pressure on our current account balance. Our current account balance is just about flat now. So there are a lot of headwinds which is reflected for the common people in terms of the rupee at all-time low. So there are there is a situation where our domestic macro is very strong, and that makes for a compelling case for rate cuts. However, our global macro or the external macro is not as smooth right now, and therefore the long-term bonds will have to wait for the more clarity on the external front, and to that extent it will dampen the movement. But I think overall, I mean, whenever the central bank is so dovish, it is never going to make sense to fight the central bank, as we
Yes.
say. I think time is right to have duration in the portfolio to a moderate extent.
Okay, okay. So, and just to close out this conversation, to sum things up, Mr. Jajoo, based on your own expectations, you said that you expect one more rate cut, 25 basis points. But do you think then after that there could be a prolonged pause based on what you are seeing? Because so far inflation has actually been below the RBI's expectations. Of course, next year you will have the base effect come into play, and ultimately the Reserve Bank of India is an inflation targeting central bank. So you could have a situation where they will have to react. But do you expect a prolonged pause?
So I think the central banks will react to the evolving situation. If you look at the policy in June, the central bank very categorically said that it has front-loaded all possible rate cuts, and therefore there is literally no room for additional rate cuts. And that is the comment that the central bank made in June. And come December, we are talking of one more possible rate cut after one rate cut. So therefore, I think central banks are not married to any particular view. It will depend on the evolving situation. The situation is changing very, very fast in the global environment as well as in the domestic environment. It is very difficult to predict. So we don't know whether the inflation will bounce back. There is a certain amount of experience bias, as they say, because in India we are not used to this kind of 0 or 1% inflation. We find it too good to be true. But at this point, the data and the overall underground, not underground, but on the ground situation suggests that the low inflation environment can continue for some time. And to that extent, I believe that the uh, central bank will cut rate and then maybe remain on a pause for a longer time. But then there are risks to that situation, as you rightly pointed out, that what if the inflation bounces back because of the favorable base effect that disappears in the coming months? What if there is a global event and therefore the commodity prices shoot up, or most likely scenario in case of India that our exports slow down because of the delay in the trade deal, and therefore the balance of payment keeps coming under pressure because the FPIs continue to sell. So there are risks at the margin, but I think the likely scenario is that the central bank cuts one more time and then they remain on a extended pause for at least 1 year.
Okay, okay. So therefore, just to sum things up, Mr. Jajoo, thanks so much for taking the time. But to sum things up, you can add a little bit of duration into your portfolio in the mutual fund space, and you could have a situation where you could have that rate, those rates for some time. Thanks so much for taking the time and for explaining all of this to us. All right, now let's talk about certain other aspects, because like I said at the start, we have to talk about your fixed deposits, we have to talk about your loans as well. On the one hand, you've had Mr. Jajoo talk about the possibility of adding duration. How do you do that? You look at gilt funds, that is government bond funds, or you can also look at corporate bond funds in the mutual fund space in order to get that benefit.